So all that it says on here, and I just want to take you through some terminology, because I'm not sure that everyone is familiar with the terminology DSL, like a domain specification language, or MDs, model-driven engineering. Are these familiar terms for everyone? Okay, so the project that I'm going to be talking about is a real-life project. So it's a project within which I and a few colleagues are industry and academia colleagues are working on developing a tool set which will enable us to be able to automatically, to an extent, generate software code from mathematical specifications. And we are focusing on the financial services industry. Now, the financial services industry, for us, means commercial banks, investment banks, hedge funds, asset management companies, insurance companies. Okay? There are four main stages to the project that I'm working on. One is to define the DSL, and within the domain specification language, the tool sets that we have the ability to be able to reason about the mathematical models that we specify. So think of these mathematical models, if you like, as models of valuing bonds or options or stock options. You may have come across these terms before. And some of these options are surprisingly quite complicated, and they make a lot of assumptions about the underlying randomness of the stock or of the bond or of the underlying asset. So the first phase, which is primarily what I'm going to be discussing today, focuses on a tool set which allows us to be able to specify properties mathematically, to be able to work out various statistical properties of the mathematics that we are specifying as it relates to financial services industry products, and to be able to auto-generate code. Within the world of finance, we also have some standard libraries which are used pretty much all over the world. So what you will find is that across different financial institutions, there are open source tools. One of the best known sources is called QuantLib, quantitative library. And the QuantLib tools allow you to be able to essentially plug and play within your Excel spreadsheets or within your own internal in-house model, if you're at JP Morgan, for example, the well-tried and tested Python routines, the C#, the C++, the Java routines, which exist in a common repository somewhere around the world. So another phase is linking our tool sets to these validated software library models which exist. Now, why is that important? It's important because from a regulatory perspective, the FSA or the prudential regulator in this country and pretty much around the world require financial models to be validated. And there's a reason why that is the case since 2007. Does 2007 ring a bell to anyone? Okay, and then we're going to move from linking our mathematical specifications to these libraries to being able to take arbitrary mathematical specifications and to be able to refine these into software code, into bespoke code. The final phase of this is going to be looking at integrating some level of intelligence, or AI, whereby the theorem proving that we're going to be doing and the code generation can actually be done almost automatically. So the idea initially is to have some kind of step-through process where a user can specify certain properties that they want to prove, and the system will say, yes, this is correct or incorrect. Going forwards, what we would like to be able to do is to specify a property and to be able to say to the system, go prove this. This is where the intelligence comes into it, and this will be a final stage of the whole project. Okay, so I just thought I would explain the overall architecture of what we're trying to do. So this is me, I'm Howard, and there are a few other people that are working on this project. A few other industrial partners and some colleagues of mine from UCL and King's College. So Soban is from UCL, and Kevin Lano is my 30-year partner in crime that we've been working on the formal aspects of computer science, and he's one of the other colleagues at King's that's working with me on this. So why financial models then? Why not something better than finance, something in the real world, like travel, tourism, or hospital, or something like that? Well, let's think about this. In 1998, there was a hedge fund in the US called Long-Term Capital Management. I don't know if you heard of that. And Long-Term Capital Management failed. Why did it fail? Long-Term Capital Management had what we would call the dream team. So you had some ex-traders from Solomon Brothers that used to exist, a bit like Bear Stearns that used to exist some years ago. And you had probably about 3 or 4 people who had Nobel Prizes in economics. So you'd have thought they would have known something about economics, something about finance, something about mathematics. And the average individual who worked for long-term capital probably had at least 2 PhDs. So they studied at Harvard, studied at MIT, so they understood mathematics very well. So why am I pressing this point? I'm pressing the point because some of the strategies that they employed used advanced mathematical models. And where the advanced mathematical models failed to work was when the volatility within the market that they were experiencing at the time was more than the models were calibrated on. Does that make sense? So essentially, what caused the failure of long-term capital, the biggest, well, my view, the biggest reason why they failed was because you had a Russia default. So Russia defaulted on its domestic debt. And because of that, there was a flight from Russia to everywhere else other than Russia. So if you were investing in Russia, you wanted to leave Russia and invest elsewhere. As a consequence, what that meant was that the correlation between investors that were previously investing in Russia, but now were investing in Europe, became closer to 1. So that meant that more people were fighting for a small pool of capital markets investments here in Europe. However, they accrued losses in Russia because they still had debt. They still had invested in debt. The losses that they sustained there caused a domino effect and led to contagion. But the models that were built by some of the world's smartest individuals didn't capture the tail end of the risk. So if you imagine a probability distribution within which normally you would expect something like 3 times the standard deviation of the market moves, they were perhaps experiencing something like maybe 10 or 12. And so their models were not calibrated towards that level of risk. Let's roll forwards to 2007. 2007, what happened then? We had a credit crunch, essentially started then. Now, I won't go into all of the innards of what happened with the credit crunch, but it's relevant to this. So you had an organization called Goldman Sachs, you must have heard of them. So, and the CFO at the time, a fellow called David Viniar, basically said, whilst here in London, well, whilst here, because I live in London, everywhere's London, so whilst in the UK, so whilst he was in London at the time, David Viniar basically said, well, our hedge fund in London failed because we were experiencing volatility moves within the equity markets that were equivalent to something like 25 times the standard deviation. Now, if you think 12 times the standard deviation is large, imagine what the skewness would be on a distribution within which you've got 25 times the standard deviation. So just imagine your normal distribution, and if you look at the limit of the volatility as it goes out to 27 times the standard deviation, this is roughly equivalent to 1 in 100,000 event. To put it into context, it's equivalent to you winning the New York State Lottery every day for a week. So that probability is quite low. What does that mean then? Again, their models were not calibrated for that level of excess volatility. Following from that point, regulators decided that, well, all models within financial institutions, which are used for calculating what they call regulatory capital, or for the valuation of financial instruments, or for the quantification of risk, have to be validated. What do they mean by a model? Well, let's see. A financial model for them is pretty much everything that goes into, let's say, an executable. So it could be the mathematics, the statistics, the assumptions that you're making about the distributions associated with a stock price or whatever you, for example. That's a model as far as they're concerned. So everything has to be validated. So when we think about the impact of the financial services industry, it's quite large. I mean, the financial services industry amounts to, I think they contribute something like 12% of GDP. They employ something like 2.2 million people. They account for something like 10% of the tax intake in the country. So it's not an insignificant sector to be looking at. So from our perspective, we think this is a great sector to start our development of our MDE tool. What is model validation? In this country, we've adopted the US or the Fed version of what is a model and what is a model validation. So when we think about what a model is, an Excel spreadsheet is a model. Something that I've just scribbled down on a piece of paper is a model. So basically, pretty much everything from the conceptualization of what is the random process which governs this particular asset, that is a model. And so regulators will require you to prove the conceptual correctness of the assumptions that you're making for all of the inputs that go into a model, as well as to verify the model in and of itself. What does that mean? So it means that people who work in model validation have an awful lot of work to do. Model validation goes beyond, therefore, just testing software applications. It goes beyond saying, here's a specification, here's a code, and we want to test the congruence between the two. Fortunately, within the world of finance, most of the applications can be specified mathematically. So the tool set that we're developing is a tool set which allows us to be able to use the techniques of model-driven engineering, within which we can specify mathematically properties of different financial products, as well as even how we can quantify the risks associated with trading those financial products. Most of these can be specified using mathematics. And so what we have done is we have developed a tool called Math OCL. The OCL is not ours, but the OCL comes from this phrase, object constraint language. So OCL is a term which was developed by IBM, and essentially, if you're familiar with object-oriented development, then there's a way of specifying object-oriented systems known as UML, Unified Modeling Language, if you've come across that before. So the Unified Modeling Language has a constraint language associated with it called OCL, Object Constraint Language. That object constraint language allows you to be able to use first-order predicate calculus, propositional calculus as a means of specifying properties in relation to the objects that you are creating. For example, you have an object called library, and you have a specific library, which is an object of that class. And you can specify various constraints on that object in terms of the number of books that can be stored in the library, etc., etc. So it allows you to provide mathematical specifications, which you can then show to be true or false, as the case may be. You showing something to be true or false is an aspect of proving the correctness of the specification, which is one of the driving forces for the work that we are doing here. So model validation for us is providing a mathematical specification of a financial problem to be solved. Within that mathematical notation, being able to prove various properties of the correctness and consistency of the specification, and then subsequently to be able to generate software code from that mathematical specification. Some of the things that we can do, for example, is we can do things like solve ordinary partial differential equations. We can integrate all of the things that you would do in rather elementary mathematics, but the things that you would want to specify mathematically for financial products, because a lot of these just make use of first order or second order parabolic differential equations, integral calculus, stochastic calculus. All of these things are things which we can handle within the software tool. So we want to be able to express them just like how we write the equations when we're building the models. So we can define various things in a language called a DSL. The DSL is our domain-specific language within which we can specify a variable. Kind of looks like a programming language, but it's not. So we can say that a variable has a certain probability distribution. A variable can be assigned to an expression, where an expression itself could be any mathematical property which expresses some kind of function in relation to a financial product. Okay? I'm going to see an example just to make things a bit more crystal. So this is a prototype editor that we have for the Math OCL tool. Now, within this particular example here, I want to work out what is the expectation of essentially a log normal variable. And so we have a lot of rewrite rules. So we have, within Math OCL, ability to be able to enter mathematical equations and a lot of rewrite rules which allow us to be able to prove or simplify the mathematics that we have specified. So here, for example, in the top pane, we enter the mathematics. Here we define x to be a log normal random variable, a standard log normal random variable, and we want to work out the expectation of that, or 2 times the expectation of that, if you like. And in the bottom pane there, you're seeing what the tool gives you. It simplifies it to 2 times e to the 0.5. If you could remember the log normal variable, you'll recognize that the expectation of the log normal variable is just e to the whatever the volatility is, in this case squared. So the standard deviation of volatility is 1, so e to the 0.5 times that. So you can enter mathematical equations, you can get simplifications of that, you can work out limits. Here we're just working out the limit of sine 1 over x, and it tells us that this, by using a Taylor series expansion, and making a substitution, give us a value of 0 automatically. Moving to a case study now where we're looking at a particular option, so a financial derivative. Here, for example, we want to buy an option on a stock. So, for example, I want to buy Microsoft, or I want to buy an option on Tesla. So I contact my broker and I say, well, I want to buy this particular stock, but not today, but at some point in the future. And my broker says, well, Howard, you're better off just getting an option. So I enter into an option with that brokerage institution. So they facilitate for me to buy an option. Alternatively, I might decide that I'm not so hot on Tesla, I want to sell Tesla. So in which case, then I could buy a put, which allows me to be able to sell Tesla at some future point, but not necessarily today. So when we look at the underlying movements of the stock price between today and whenever I can exercise that option, we have to make some assumption about the probability distribution associated with that stock. And as it turns out, the common assumption that we make is that the stock price moves according to a log normal distribution, and we can actually work out the value of the option in any number of ways. The way in which I'm working this out in this tool is to use a sort of lattice or a tree-based approach. So it's a discrete-based time approach. An alternative is to use a continuous time approach within which we solve for maybe using Grimm's formula for solving a second-order parabolic differential equation. But here, we're using a tree-based approach. And the reason why I'm doing that is because we want to be able to validate this model. We want to be able to express properties in Math OCL and prove various properties about it. So without going into all the details, one of the things that we might want to do is to be able to say, well, I've got this option. Can I replicate the option somehow? What does that mean? By holding a certain amount of cash and a certain amount of the underlying stock, can I replicate the value or the payoff of the option? Which is one of the things that traders do all the time. When the stock price goes up, we want to be able to sell a certain amount of the underlying in order to be able to offset the change in the value of the option, and vice versa. So here is a tree, which is a lattice-based tree telling us how could the stock price evolve through time. So if you imagine that the stock price started off at 100, which is what S0 is, it can either go up at one step in the future or it can go down. At the next time point, it can either go up again or it can go down. Very straightforward. Now, this kind of model can be used for valuing any kind of derivative, well, any kind of option. So in MathOCL, we can enter essentially that tree, but by entering the up and the down movements mathematically. So we can specify what these are. And beyond that, we can prove certain properties, such as what should be the hedge ratio, and we can solve an equation for that. So MathOCL allows us to be able to do that. So in the top panel, let's just go back to what I've got here. In the top panel of MathOCL, we express whatever specification of whatever system. So this could be an airline system. This could be, a sort of renal kidney failure system. So it could be anything at all that we can specify mathematically. So we specify the properties, and then we may want to prove some aspects of our mathematical properties that we specified. So we could say, well, okay, now that we have this option, we want to be able to prove that the option is equal to a certain value. It's one of the things that we want to do. So you've got an option, we want to be able to prove that the value of the option is equal to a certain value. So we express a formula, just like what we're trying to do here in MathOCL, and then we say, prove that the value, if it's a function value that we're looking at, is equal to some value. So we can do things like that. So MathOCL allows us to be able to enter specifications, check the type to ensure that we've entered those specifications correctly. It also allows us to be able to simplify formulas. So if we've entered a formula, it allows us to be able to refine the formula to a point where it cannot be simplified any further. Again, this is very, very important from the perspective of clarity. Our ultimate objective is not just to simply have a theorem prover for mathematics. Our ultimate objective is to be able to specify things mathematically, to prove that the specifications are correct, and then to be able to generate software code. So at this point, we're still at the specification stage when we are entering specifications into the editor. So as I've mentioned to you previously, we can solve for various equations, for various parameters. So here, we're solving for the hedge ratio in an option. We don't necessarily need to know what it is, but you just need to know that how it says that you can enter an equation, you can press a button, and then you can solve for the hedge ratio. So the tool allows you to be able to do that. We also want to be able to move from doing theorem proving to the generation of code. Now, how do we do that? So having specified the mathematical properties of any system that we want to specify, we can then transform our specification into a language called OCL. OCL, I mentioned that to you before, object constraint language. So the object constraint language is an open source declarative language which anybody can use.